Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to share with you my analysis of Mastercard. So let's get to it. As you may already know, I divide my valuations in qualitative and quantitative aspects. The qualitative includes past performance, management, competitive advantages, and financial position. Once I'm happy with all this, I go to the quantitative portion, which includes making projections and calculating intrinsic value and IRR. So let's go to past performance. First of all, an overview of the business. A typical transaction in the core network of Mastercard involves account holders, issuer, merchant, and acquirer. In this illustration, we can see better. We have the account holder, then the bank of the account holder, then we have the merchant, and then we have the bank of the merchant, which is called acquirer, and in this case, this is called issuer. Mastercard network connects these two banks and provides all these services. And we can see here how they split their revenue, and these are the different services they give. For example, we have domestic assessment, when these are fees charged when the merchant country and the country of issuance are the same. We have cross-border volume fees, which is when the merchant country and the country of issuance are different. We have transaction processing, which includes switching transaction, connectivity, and other processing fees, and these are charged both for domestic and cross-border. And we have other revenues, which are value-added products and services, like, for example, data analytics, cyber and intelligence, loyalty and rewards, etc. These two, transaction processing and other revenues, are the ones that are growing, we'll see, faster. And then we have rebates and incentives, a deduction from revenue. And when we see net revenue is going to be, this is the gross revenue, what comes from these four items. And this deducted the rebates, we get the net revenue. One other point, the strategy, where they grow their business is from personal consumption expenditure growth, driving cash and checks towards electronic forms of payment. Here is where I think the main driver of growth may come, is like a tailwind that the business has. The increasing in their share in the payment space, I think, is harder because there's so many players. Provided an integrated value-added products and services, I think here is also a point where they can grow their business. And in other new, let's say, payment flows, like business to business, person to person, business to consumer, etc. This is a view, let's say, of Mastercard's business. If we see here the income statement numbers, which is mainly revenue and profits, we see that net revenue has been growing quite substantially, other than this year here because of COVID. We see here the gross profit, the operating income in green, and the EBITDA, which is very similar to the operating income. And then we have operating margin and gross profit margin, which, as you can see, are quite healthy. The gross profit margin is 80% gross margin, roughly, and the operating margin is in the 40 to 60%. These are great numbers, and you'll see later. But here you can notice as well they are growing, especially operating margin, with the growth of revenue, which is something that you normally would expect. Then the revenues, we see they have been growing at a compounding annual growth rate of 10.7, almost 11% for the last 10 years. And the operating income has been growing similarly at 12%, roughly 11.5 for the past 10 years in a compounding annual growth rate. If we go to revenue by segment, which are the segments I showed you a couple of slides ago, we have gross revenue, which is without the incentives. As you can see, this number is much larger than the net revenues. Net revenues are in the 16 billion level, and this one is in the 25 billion level. So it's quite a substantial amount of incentives that they have to. And then we have cross-border volume and domestic assessments. Here growing. These two, the green and the orange, are growing at 9 and 6%, decent levels of growth. The cross-border one was impacted by COVID the most, because this is where mostly the travel business is in cross-border. And then we have the transaction processing, which is the gray line here, which is growing quite fast. And the other, which mostly is data analytics, cyber and intelligence, loyalty, and all these are value-added products, which are growing, as you see here, quite substantially, 20%. Then we have, in a cash flow basis, it's also very healthy. We see free cash flow growing also quite fast at a 15.5% on a compounded annual basis. And we can see here the operating cash flow in blue is very close to the free cash flow, because this is the expenditures. This business doesn't need too much cash to run, I mean, in terms of capital expenditures. And in terms of capital expenditures to revenue, even though they have been going up, they are in the 2 to 2.5% level now. The way they use cash, this is the free cash flow, the blue bars, and you see these are dividends and share issues or buybacks. You see that they are almost the same. Whatever they have in free cash flow, they use to pay dividends or to share buybacks. Normally, this has been the case. The way they give back most of the free cash flow to shareholders. Okay, so and then a summary of operating performance in terms of return on assets, return on equity. You can see quite substantial numbers, and this one, which is the return on invested capital, quite healthy return on investing capital, and as you see, they are growing, they are improving. So the fact that the return on investing capital is higher than the cost of capital, which in the case of Mastercard is in the range of 10%, 9% or something like that. That means that they are creating value. So all the capital that is invested, even though they are giving back capital they're returning capital to shareholders through dividends and buybacks, they still have quite a substantial amount of capital working in the business, and it produces every year. It creates value because it has a higher return than the cost of capital. And then in terms of these other ratios, gross margin and operating margin are also quite healthy. What I like to see here is the operating margin is improving as sales improve, because they are leveraging their operations, and net margin as well is improving. So these are all very nice numbers. If you see here, free cash flow to net income is almost the same. It's a good sign. It's a business that is producing as much free cash flow as net income. This is a view of past performance. I am happy with past performance. So let's go and see management. Okay, in management, the first thing I'll do is I go to the proxy statement. I check the compensation of the directors, which I think it's quite okay. It's very standard. And also the compensation for the executives. And this is something I normally see in many of these companies. And it is something I don't like very much, because it's quite standard in the industry to compute all these executive compensations based on the complex formulas that I think are a waste of energy and are a waste of time. They don't motivate anybody, because to understand these formulas is complicated enough so to get incentives is quite difficult in my view. But this is the way they do it. For example, I want to show you why I don't like this. They have this structure, let's say, in annual incentive, which is cash incentive. Let's see, the cash incentive is based on achieving a corporate score. The corporate score is based on two steps: financial score and strategic performance adjustments. And they calculate this based on here this table, and which is a table that has thresholds, targets, and maximums, and for each they have some percentages and goals, etc. And they get finally a score of 129. And then step 2, which is this strategic performance adjustment, is also based on these metrics, and when they calculate that, they finally get 125%. So with 125 and 129, they get a corporate score. And the corporate score, they multiply that by the performance of the individual, and the performance of the individual depends on their objectives of each individual. So they put objectives to each individual, which are very difficult to measure. And then at the end of the year, they say, okay, I think, or we think that this person got a 181% of his goal achieved, this one 150, this one 150, and they get an incentive, which is based on the base salary, 2.5 times would be 100%, and because this person achieved 181%, this is what he is going to get, 181%. This number is coming from here, the final bonus payout, which is the corporation times the individual. And then they have similar things for long-term incentives here, also based on, for example, the performance stock units was based on earnings per share and net revenues, and also relative performance of a total stock return versus the Standard & Poor, and that gives a final payment. It's really quite complicated. It's not that I want to explain it how it works. I want to explain how complicated it is and why I think it's a waste of time. Also, the stock options have a similar thing. 3-year adjusted net revenue and earnings per share, and then they have targets, maximum, actuals, and then they get a score. So all that gives them performance stock units, options, and restricted stock units, and this is the total. Well, when we see the totals, they are quite okay. If we see this is the CEO earning 17 million plus whatever he's earning in incentives and in salary, it's nothing too outrageous. This is what he's going to get finally: 23 million, 20 million, 18 million. It's okay, average for this type of companies. Then if we check the ownership structure, there's 88% of the equity ownership is in public hands and 11% in the Mastercard Foundation. And Mastercard Foundation will sell this 11% in a gradual basis in, I think, the next few years until 2027. Even though there's a Class A and Class B stockholders, the Class B stockholders have almost no ownership and zero voting. I like the fact that the voting power is in the one that owns the company, public in this case. Let's have a summary of management and the traits I see. Capital allocation and return on invested capital. As I showed you before, here return on invested capital is quite healthy and growing, much higher than the weighted average cost of capital, so I am happy here. In terms of alignment with shareholders and the compensation, we see, I showed you from the proxy, we see here that they have a salary, stock awards and options. If you see 15 million out of the 23 are stock awards and options, and in essence alignment with the results of the company, and you can see that is quite substantial in most of the executives, so that one is something I like and it's okay, even though it's not as large as other companies. Some companies pay almost 80% in stock, which I like, but well, this is quite standard, it's okay. Stock ownership by insiders. If you see this table here, you can see how much in terms of the actual ownership as a multiple of the base salary for each of the executives. And the CEO has 81 base salaries, which means $100 million in Mastercard stock, even though he is required to hold on only 6 million. From the company view, 100 million in ownership probably is not that much. But from the personal perspective, I think 100 million is quite a substantial amount. This is a great vote of confidence from the CEO into Mastercard business, I think. And this is something I like. In terms of dividend policy, Mastercard, the slide I showed you a minute ago, almost all free cash flow is paid either in dividends or share buybacks. So the dividend policy that they have is they are paying very small amount in terms of dividends, and the rest is in share buybacks. I like this strategy because the share buybacks, they can adjust to whatever the needs of that year. So I like what I see here, that they don't tie themselves to large payment in dividends. First, because as you already know, I don't like dividends as a shareholder because they are inefficient tax-wise, I think, and they are also inefficient. The fact that the company gets tied to pay a dividend annually and make it grow annually, which is the expectation, restricts the capital allocation flexibility that they have, and I don't like that. But in the case of Mastercard, I think that they are doing a good job here by keeping dividend low and paying the rest in stock. I mean buybacks. Well, long-term vision. There's nothing in Mastercard that I can say. They don't have like a founder or a certain culture that is long-term oriented. But you can see in the numbers that the decisions they are making at least are having good impacts in the long term. So I'm happy here. In terms of this regard for Wall Street and the short-term objectives, Mastercard is quite standard in this sense. They treat their investor relations very in the way that most of these companies do. So they do presentations every now and then, CEO interviews with some of these analysts. So nothing. This is neutral to me. All in all, I think I'm happy with management. And so let's move to competitive advantages. Competitive advantages, the most powerful that Mastercard has is the network effect. And as you know, the network effect works that the more account holders, the more merchants will want to receive Mastercard, and the more merchants, that makes it more convenient for account holders. So this is a virtuous loop that fits into itself, and it today Mastercard could be one of the largest network effects out there. 3.5 billion credit cards or cards out there, and most of merchants receiving Mastercard, not only online but physically. So this is going to be very difficult to break from a competitor. Today you have Visa and Mastercard, both of them roughly with 69% of all transactions that occur in the world. And that is really powerful. Another one of the advantages could be called toll booth type of business. The network of Mastercard in this case is similar to a bridge, like a toll bridge, where you want to reach from account holder to merchant and from merchant to account holder. You have to go always through that system. And there's also a way to go directly, which is if you pay cash, or today more and more probably with Bitcoin or even PayPal, are ways to pay directly to the merchant without going through this toll, let's say. But if you see in the case of PayPal, you can fund your PayPal account with a credit card. So in essence, not all the payments that you make through PayPal will be, let's say, outside this bridge. Some of them will be inside this bridge, which is why I put PayPal here as well, between the account holder or the PayPal holder and the bank issuing a credit card. Similar to Apple Pay and GPay or Google Pay, both of them are here in this, let's say, in between the issuer and the account holder. either with their own bank or with the issuer bank, but they feed into this network. The fact that Apple, with all the power, technology, and information, and all this, with a large percentage of the population of the world with an iPhone, and they had to go through this as the best way to get into the payments system. They couldn't do something between merchant and account holder, avoiding, let's say, bypassing this network. Same with Google. They had to go this way. And on the other side, you have other companies which are entering this payments industry, like, for example, Square or Stripe, which are more on the acquirer side of the business. They are in between the acquirer and the merchant. In this acquirer merchant, you have these two big companies, Fidelity Investing Services and Fiserv, which have been acquiring and consolidating. They are in between these two. They are the main providers of services to the acquirers, which are the banks. And they normally left outside the small merchants, which probably were not a good business for them. But Square came and is making a business of attracting these small merchants, bringing them into this whole payment ecosystem. So even Square and Stripe, both of them are using these networks. Other than in the future, if we have Bitcoin as a mean of payment from here to here, even in that case, I think that Mastercard can, in the same way that you can pay with any currency, I think in the future you're going to be able to pay with Bitcoin as well, using your Mastercard. So it's easier for Mastercard to attract all this than for them to disrupt this service, for the time being at least. And the main competitor for this network, I think, is cash. And cash, I'll show you in a minute, is diminishing in the world as a mean of payment. So there's a tailwind there for Mastercard. If we see here from this global payments report, you see in 2020, when you were paying online, cash on delivery was 3% of the transactions, and they expect it to be 1.7%. In payments in, let's say, physical point of sale, cash was 20% in 2020, and they expect it to be 12.7% only in 2024. And this has accelerated due to COVID and the fact that we are doing everything online, lots of things online. So this is the big growth in digital and mobile wallet, which mobile wallet is just a virtual wallet that stores payment cards information on the mobile device. So again, every growth in this mobile wallet thing is going to be a growth for Mastercard. So I see this tool booth type of business very, very strong competitive advantage and very difficult to disrupt, even though technology is and lots of funding is going into what are called fintech companies, which some of them want to get into this payment system industry. Some of them, as I said, are here already or here, but it's hard for them to break this link. And I think that if you want to avoid using Mastercard, and let's say as a society we don't want Mastercard, we want a better service. Well, I don't think that you can get a better service today. Probably with the technology in the future you can link these two, but it's not that easy only to link these two. There's lots of services that go in when you want to link these two. For instance, if you pay using PayPal directly and you funded your PayPal account with a bank account, whatever happens in this relationship, your avenues to complain as a customer are smaller than if you funded this PayPal with a Mastercard. There are already regulations in place in most of the countries where if you pay with a credit card or a debit card or using this network, because all the checks that are embedded in this service can provide you with a resource, let's say, to claim, and it's regulated as well. While if you go here, you avoid this network, but you also get outside all these checks, as I said, that are embedded. So you cannot, your choices are diminished when you want to sort of like make a complaint. And that's one example. It's full of other examples. Like for example, as an issuer or an acquirer, you get all these value-added products that PayPal or whomever gets in here will have to be able to get either somewhere else or internally. So it's quite hard, and in the end, the day that we replace Mastercard or Visa, I think we're going to get, either as a user or as a merchant, a service that's not going to be much better, I think, at least for the technology we have today. We have to see, but I am confident that in 10 years at least, this is going to be very difficult to disrupt, even with the technology that we have today, that, as you can see, many big companies are trying to get. There's another one, for example, another example I want to show you with Facebook. Mastercard cardholders can now send and receive money using WhatsApp in Brazil. So WhatsApp, which is a company from Facebook, and enabled Facebook Pay. So they want to get into the payment business as well, but to get into the payment business, they have to do it with Mastercard. And Mastercard, if you were able to send via WhatsApp money to another person, that means that Mastercard would be competing, let's say, with PayPal in that sense, and with all the other services that are P2P, which is person to person. So I think that you can see that even the big guys need Mastercard or Visa to get into this payment industry. And let me show you here something that a nice article from Nasdaq.com, contributed by the Motley Fool, which has interesting numbers that I want to share with you. One of them is that the big three, meaning Ethereum, Dogecoin, and Bitcoin, the big three are in the neighborhood of 1.5 billion transactions per day. And if you see the transactions per year for Mastercard and Visa were 165 and 90 billion transactions per year, which is 69% of all the transactions this year at least. 69% of the daily transactions, or daily, same. They are worth $870 billion between Visa and Mastercard. And these big three, 1.5 million transactions per day, which is 0.15% of the daily transactions, it's worth, between the three of them, $1.5 trillion. So what I want to show you here is that, let's say that we can replace the network from Mastercard, let's assume, with Bitcoin. The fact that Mastercard as a business and Visa get 870 billion of valuation because that's their income, and this is the future income value. So what would be the cost for society to change Mastercard to Bitcoin or any other one? If we follow this, it's going to be double the cost. So why as a society we would want to go to Mastercard? I mean, these are things I just want to highlight. I'm not saying that it's not possible, but if we want to replace Mastercard and Visa and disrupt that business, it means that it has to be better for everybody and less costly. And if we replace it with Bitcoin, it doesn't seem to be, or any of the others, doesn't seem to be less costly. That, not to mentioning the cost in energy and all other things that it may have. But I'm not against cryptocurrency. I'm just putting some figures, mainly to strengthen my view that Mastercard as a network is harder to disrupt than what probably some people think. So I want to show you also some a part of interview that the New York Times had with the CEO of Mastercard, and the interviewer asks, "You've tripled the revenues, and you've processed 6.5 trillion last year." This is in December 2020. $6.5 trillion. But the digital payments startup Stripe says it processed hundreds of billions last year, and Square says it processed 106 billion last year in transactions. Talk a little bit about these companies and how you look at them. And I know in some cases they are partners with Mastercard. I get that. But it reminds me a little bit of what streaming companies or Netflix has done to Hollywood. They have come in an area that they have come in an area that is your business and moved forward really quickly. And right now, I think Stripe is 70 billion valuation, possibly 100 billion. Talk a little bit about this, and if you've missed something like a lot of big companies. So this is an interesting question. Probably is this a long-term risk factor? I mean, whether these companies can disrupt Mastercard. And this is the answer from Banga, Mr. Banga. My general view is that we weren't in the same business that a lot of these were. For example, Square, what they did was they enabled simple, easy sign-on for merchants to become eligible for physical payments done electronically. This is a little bit what I explained a minute ago. Well, guess what? Those are still our rails. We are not in the acceptance business. Mastercard has never been in the business of going to sign up merchants to accept our payments. That's done by the acquirers. So he keeps explaining that and saying that is not their role. I mean, their role, if you go back to the illustration I showed you, Square is here, Stripe is here. It's in fact helping them to grow their business. So I don't think that the CEO is looking at these guys as competitors. In fact, they probably are more aligned with Mastercard than in competition with Mastercard. Another thing in competitive advantages, if you see the non-cash transactions, these countries, Singapore and Netherlands, are quite high. But if you see the US, Germany, and here are the rest, there's still plenty of room for transactions to go from cash to non-cash. And that is, I think, the main competitor for Mastercard is the payments with that go in cash, made in cash. And there is a trend, as I showed you a minute ago. You see that cash is diminishing in terms of penetration for payment as a payment method, and that I think is going to be taken by Mastercard and others. So there's a big tailwind there, I think. So then they have also intangible assets, which is mainly the brand and the technology. These are very difficult assets, let's say, to build. Technology, Mastercard, we can say it's mostly a technology company because they have software and practices in place that make all these transactions possible and quickly and safely. And then the brand, well, it's you know the brand. It's probably everybody in the world knows Mastercard, and they are known for providing good service. So this is a great advantage. And then switching costs is another competitive advantage that they have. Once you are within the system with a card and everything, you're not going to change to another system like Visa just I mean, you need the hassle to move from one to the other is more expensive than the potential savings that you're getting. So I think, but this is not as important in my view. Summarizing competitive advantages, we have network effect, we have the toll business, we have the intangible assets, brand and technology, and we have also switching costs. So these are the 4 competitive advantages, and I think is one of the companies with more competitive advantages of the ones I have analyzed, and that's why Mastercard is one of the main portions of my portfolio as well. A potential threat to keep an eye is, if you read here, both Google and Apple have their sites on banking capabilities, and Facebook as well. And as I showed you, the 3 of them, Google, Apple, and Facebook, are all getting into this banking system, let's say, or payment industry, using Mastercard or Visa's networks. So who knows in the future what's going to happen, but so far, even if you are large with lots of money and lots of users and lots of reach, even in that case, it's hard to do it on your own without using the network of Visa or Mastercard. So let's see what happens in the future. Could be a potential threat, probably. Who knows? But for the time being, I am very, very happy with Mastercard or Visa holding their ground. So those are competitive advantages. I think Mastercard meets competitive advantages. So let's move to financial position. In financial position, here we have the debt structure. You can see that mostly their debt is in bonds, and you can see here bonds up to 2030, 2046, 2048, so quite a long-term structured debt. And if you see here, the effective interest rate is quite low in the 3-4% level. They have a great credit there. And if you see how it's distributed in the next few years, most of it is from 2025 thereafter, the payments. So I don't think that they will have any problems in making these payments in the next few years. The balance sheet here, you can see cash and equivalents 10 billion, and then long-term debt 12 billion. So they're almost in 2 billion of net debt. So I don't have any issues with the financial position. They are in great financial position. They have great EBITDA to pay for the interests, and as I showed you, the structure of the debt is really good. So no problem here. Past performance management, competitive advantages, and financial position. All these 4 items, in my view, are met. Let's move now to the projections. So let me show you my model here. This is the revenue for the next 10 years. The way I come with the revenue is I open the same way that Mastercard opens their segments, and I see the way that they have been growing in the past 10 years for each of these segments: domestic, cross-border, transaction, and all that. And what I'm going to do is I'm going to assume similar growth than they have growth in the past. But I think that I'm going to add a few percentage points in some of them, which are, I think, going to be benefited by the movement to online, which has been accelerated by the COVID, and that's going to persist, I think. So these are the numbers I am assuming for each of these items, and also rebates and incentives. I'm going to keep them growing at similarly than in the past. So when I add all this, I end up with this revenue, which represents a growth of 15% per year on a compounded annual growth basis. And they have been doing that in the past 10 years. It's been 10%. Of course, that 10% could be a little bit higher if we measured it up to before the COVID, because last year the cross-border volume fees were hit very, very much by the stoppage of flights and the tourism. It's going to accelerate, I think, in the next 10 years. This is my assumption. Probably could be a little bit aggressive. But if you see here, from Statista, they are assuming that from 2021 to 2025, the digital payments industry is going to grow at 12% per year. And if we start from 2020, which 2020, this was the volume that was transacted, from 5 billion to 10 billion in 2025, which is their assumption, the growth is 15.1% on a compounded annual growth rate. So this is similar to what I am assuming that Mastercard is going to grow, especially because I don't think that they're going to gain any market share from other payment players, but everybody is going to gain market share from cash. So this is the way I come with my assumptions of revenue. I also have checked some analysts' reports, and they are making similar assumptions at least to 2025 on a 15%, roughly on a 15% compounded basis. So this is my revenues here. Gross profit, I am assuming that they start from a gross margin of 75% and keeps going up with the sales. Operating income, I'm assuming that they start with a margin of 53 and keeps going up also to 60. And that's how and then depreciation and amortization. I keep the same level of depreciation and amortization versus cost of goods sold than in the past. You see here this number is similar to in the past. So that's how I come with depreciation and amortization, and I arrive to EBITDA. EBITDA is going to grow a little faster than revenue, similar to what has happened in the past, because they are leveraging their growth versus expenses. And I am also assuming diluted weighted average shares outstanding. They have been buying back share quite substantially at a rate of 1%, 2% per year, as you can see here, 3% even. I'm going to assume that they keep doing that at a 2% per year. The outstanding shares are going to keep going down. And these are the assumptions for the income statement. Let's check now the assumption for the cash flow. And in the cash flow, I assume a 15% growth of operating cash flow, going all the way up to 17%. Capital expenditures, I assume 2.5% of sales, similar to what they have been spending in the past, and that gives me free cash flow, this line here. That's going to grow at 15%, roughly similar to revenue. So these are the projections, the main metrics that I need to value the company. So let's now go and check the intrinsic value and internal rate of return. Let's go back to the model, and with the EBITDA projections that I just made, and 20 as enterprise value to EBITDA, which, as you know, is important here in year 30. I mean 2030, in year 10 of my projections. The EBITDA I multiply by 20 and I get the enterprise value. And with the net debt that I am assuming, which is going to be static at 13 billion, I get market value. The market value divided by the stocks outstanding at that moment give me a price, which is share price based on EBITDA, which is this one, the one I'm going to assume that I am assuming, 958. I do the same thing for free cash flow, assuming 28 times free cash flow as the value of the company year 10 of my projections. So I multiply 28 billion, which is the free cash flow I'm projecting, times 28, gives me the enterprise value. I deduct the debt, and I get 780 billion as market cap at year 10, which divided by the number of shares give me this 949 share price, projected share price. The average of these two give me my target price for in 10 years, which is 954. And remember, 28 in this case means the following: is a growth in year 11, 12, and up to 20 of my projections. That means 2030 to 2040 is this is the growth of cash flow that I am assuming, and with this debt cost and this equity cost, which gives me this cost of capital. And if you project this, it gives you 28 times free cash flow of 100. So if we start with free cash flow of 100 and make it grow at this level, then it gives you 28 times. So this is what 28 means in essence. 954 would be my target price, and with that target price I come here to my calculation of internal rate of return, the current price, target price in 10 years. That's almost 10 years period. This is the yield, which is the free cash flow less any stock compensation, gives me 3.18 per share, and the internal rate of return would be 10.84. Because I would be willing to invest with a 10% internal rate of return, I would be able to pay 107% of the current price, so $406. So that means this would be my fair value, $406. So the company trading today almost at fair price, let's say, and 379. But this is a business that I am willing to buy at fair price, because it's as you saw, it's generating value. It has a perfect competitive position, so I think in 10 years it would still generate value. It's a business that no matter what the price volatility, in 10 years is going to be much more valuable than today. It has a tailwind of the transformation of the economy to digital. So I think it has lots of attributes that I like, and it's trading at a good price. So that's my valuation of Mastercard. I hope you like it. If you like the video, please don't forget, subscribe to the channel, like the video, press the bell and all that. And thanks very much for watching, and see you in a couple of weeks with another valuation. Probably the next one is going to be Apple. So see you then. Thanks very much.